Hello and welcome back to The Note, coming to you again from New York. Now, we've had a relatively quiet day on world stock markets. Most of the markets outside the US were up somewhat. Here, the S&P and the other main US indices were down somewhat. Oil continues to disappoint after its rally. It's now dropped more than 10% from its recent high. I'd like to concentrate instead on the earnings season, which is really dominating sentiment when it comes to the US stock market. Now, this is the critical chart which we're showing you here. This shows you what consensus expectations were for third quarter earnings growth at the beginning of the year and how it has evolved since then. You can see that at one point people thought this was going to be a very strong quarter. By October the 1st, by the point that the quarter itself was finally in the books, there was an anticipation that earnings were going to fall more than 4% year on year. Now, the first and second quarters, similarly, by the end of those quarters, people were braced for outright declines in earnings. In both cases, that didn't happen. Companies had successfully lowered the bar for themselves. But as you can see, if we now look at the most recent number, as polled by Thomson Reuters, you can still see that we are braced for a 3.5% decline in earnings after quite a lot of companies have reported. It really does look as though we will end up with an outright annual decline in earnings per share this quarter. That'll be the first time that's happened since 2009. Now, that is not because of margins. The margins are in many cases very much improving thanks to cost cutting, thanks to buying back shares. Revenues, however, have been horrible. Everybody knew that they were going to be bad thanks to falling commodity prices and thanks to the strength of the dollar. But they have actually been worse than expected, and far fewer companies than usual have managed to positively surprise the market when it comes to revenues. When you look at individual stocks, this means that you've had some very drastic reactions to earnings announcements. If we take a look first of all at St. Jude, medical device manufacturer, and as you can see, this is comparing it to the S&P, one of the big market stars for a lot of the year. St. Jude actually met its earnings forecast. It didn't fail to meet earnings. Its revenues were not down very much at all, but it wasn't very positive for the future. And in the current environment, you need a positive surprise to avoid what happened to it, which is a very sharp fall. It's now actually underperformed the market for the last year. But now if we take a look at General Motors, which also announced its results today, again, this has been on the back of an outright fall in revenues, but its profit growth was very impressive indeed. This doesn't necessarily tell you that the US or Chinese economy is doing so well, but it does suggest that GM is getting its house in order and finding ways to eke out profits. As a result, again, you can see a very dramatic move upwards in its share price. I suspect, at least until we hear from the Fed again at the end of next week, I suspect we are going to see quite a few more days of trading like this one. Very poor revenue numbers and great attention paid to whether companies can find ways to eke out profits in a very tough environment.